Inflation actually ticked up month over month. It was in line with street expectations, economist expectations, but it's the first increase we've seen since September. When you hear those comments from Barkin, or we heard comments from Mary Daly today as well, does it seem like another hike is in the cards?
It seems most likely. Again, they have to make sure that they have slayed the inflation dragon. 5% is nowhere near their 2% target. The direction seems to be in that direction, but the speed with which it is approaching that desirable target, or at least the certainty that it's going to get there eventually, is still pretty slow. So I think there still is a reasonable probability they'll do another 25. I would be advocating for that if I were still sitting at the table. I think the markets can take this. We have enormous risk right now, as was just articulated in that previous segment, in different sectors. The banks are clearly going to be more severely audited, severely supervised, are going to be more conservative, particularly the regional banks and the community banks, where about a third of all credit goes towards commercial real estate. So we are going to see an impact of the reaction to Silicon Valley Bank. That's worth a few basis points. There's a debate here between apparently the chairman and the governor's staff, board of staff. But I still think we have a little bit more to go. We have to make sure that the inflation dragon has been slayed.
The tightening of lending conditions, the cost of capital going up. We've been talking about it. There's this expectation that it's going to happen. Have you seen signs in the data that you watch on a regular basis that it is actually taking root yet?
Yes, I think you see signs. On the other hand, we don't have this extreme a reaction as some people thought. You need to look at the Fed's discount activity, the discount window, and the special facility that was just put up as a result of Silicon Valley Bank. But we know that there has been a nice flow into government funds, that is, money funds that are invested in treasuries, short-term treasuries, out of the bank deposit world. That seems to have slowed down. So we're seeing some mitigation of the fear. But there's always the risk that one of these institutions somewhere who relied on free money for too long, venture capital, for example, is a great example here. It's just dried up. Because when money is free, you can look out to infinite time horizons. Also, we're seeing it in the tech world. We're seeing it in CRE, commercial real estate. There is still an adjustment, guys, Morgan and John, still taking place, and I don't think it's over. And the markets are volatile and vulnerable.